So we want to begin with introduction to accounting. We want to know what accounting is all about and why we need to study accounting in the schools. First, we will get to know the meaning of accounting. Accounting is the process of recording, classifying. Accounting is the process of recording, classifying, analyzing, and interpreting financial information to make users able to take financial decisions. We will equally know who the users of accounting information are and why they need the accounting information. So accounting begins with recording of business transactions. On a daily basis, any business involves itself in recording of all the transactions. When money comes in, when money goes out, it has to be recorded. By the time the records are kept, the accountant will have to analyze, that is, after grouping the records as they relate, has to be used to carry out some analysis that will be used to make interpretation on the state of the business to inform users to make wise and economic decisions. We want to look at the importance of accounting. Why do we need accounting? Why does a business need to keep accounting data? It is important because accounting information is used to evaluate the performance of any business. The records that are kept over time can be used to evaluate the business, whether the business is doing well or not doing well. It is important for the management of the business to make decisions, financial decisions. It is important to know when a business is running out of cash, that is the liquidity position of the business. When a business needs to borrow, when a business needs to do some other things to inject cash into the business. It is used to also provide permanent records of transactions of the businesses. It helps a business to monitor progress. It helps a business also in tax assessment, and it enables comparison to be done over time. For instance, a business can be able, with financial information, to compare performance of the business between years. For instance, between 2005 and 2006, a business should be able to know, I did well in 2005, in 2006, I did better. Then the business should be able to plan on how to do better in the future. It is also used for forecasts. You can use financial information to forecast the activities a business wants to carry on in the future, whether to increase sales, to reduce costs, and so many other things. It is equally used to ascertain the assets and the liabilities of a business. It is what enables business in planning, the managers in planning. So I want to go to just a brief history. We are not going deep into the history of accounting. Briefly, accounting started in the olden days when people could not even read and write. They were able to make records with what is available to them as at that time. Some were keeping records of business transactions with stones, with sticks, some making marks on the wall and things like that, just to enable them to remember what happened in the time past. So it continued like that and got improved. Till after a time when some traces were made to Babylonian kingdoms and some other kingdoms in the ancient days, that these records were found, and people started using these records to actually know what happened in the time past. Until there was a breakthrough with this man, Luca Paciolo, in 1494, who developed the system of double entry bookkeeping. Accounting actually started very well from that time, because the basic principle of accounting is double entry principle, which this man developed. And from that time, the present day sophisticated system of accounting started. So we can really appreciate this man, Reverend Father Luca Paciolo, who introduced the double entry bookkeeping in accounting. So from there we go on to those that use accounting information. We have many of them. We can make reference to just a few of them. So I will talk about the employees of a business. The employees of a business, I would like to list them so that when I start, I will just go down like that. We have the employees. We have the owners, and sometimes the shareholders. Their competitors also. We have creditors and suppliers. The government also and its agencies. Even the customers, those who use what a business organization provides, whether goods or service, they equally need information to make decisions. The general public is there. The analysts. So let's take these few. There are others. These are users of accounting information. The employees of an organization, they are the staff, the workers in any business organization. They need to know what is going on in their place of work. They want to know whether the business is able to retain them and pay them their due. That is, their salaries when due. They also want to know the, I will call it the insurance they have to continue in that organization. They want to be sure that the business will not fold tomorrow. The employees. So they look into financial information of a business to know actually that this business, if I continue with this business, at least I'm sure that when it is due for me to be paid, I will be paid. And not that tomorrow this business will fold and I'll start looking for another job. That is the employees. Then the owners of a business. They want to know, some of these owners are not the people managing the business. They might give the business over to other people to manage for them. That is when we talk of shareholders. Shareholders are not normally part of the management of the business. But when it is a business like sole proprietorship partnership, the owner can as well be the manager or the managers. Now, the owners, including the shareholders, they want to know the investment they put into this business, the money I invested into this business, am I sure that on the long run, I will continue to get returns? Am I sure that this business will really continue. And those that are managed by other people, they will want to know whether those people are really managing the business very well, or self-interest might make the managers to overturn the profit of the business to themselves. We also have another set of shareholders, but this time potential shareholders. Potential shareholders. These people are not yet shareholders in the organization, but they equally want to know what is going on in the business because they have the plan, or they have it in mind, that if I'm sure that this business is doing well and will continue to do well, I can invest my money into it. So they are potential shareholders. Once they ascertain that this business has a guarantee that if they invest into it, they will not lose their investment. They can go into it. So they also want to know what is going on. Then we have competitors. Competitors are firms other than the business organization in question who are into production of similar goods or service with the same organization. So they want to be able to compare their own operation and that of the other business, whether they are doing well or they can compete favorable or they can even compete better. With the information they get in the other business, they should be able to take decision whether to improve or to go at a particular space. Then we have the creditors. Okay, let me say trade creditors. We have trade creditors, which are the suppliers, and then loan creditors. Loan creditors are mostly financial institutions and then some other organizations that give loan to any business organization to carry on its activities. They would like to know, this business that I want to give my money to carry on the operation, which guarantee do I have that my money will not be lost, and that when this loan is due to be paid, that I will receive my money, and also the interest that will be paid on the money I gave out, will they be able to pay me? Then the suppliers are organizations that sell goods on credit to a business organization. They are at the same level with the creditors because it is also a form of credit to the business. So when they give out their goods to the organization to sell and pay them at a particular time in future, they want to be sure that this payment will come as at when due. Those are the suppliers. The government and also its agencies. Government want to know what is going on in any business organization, and this will enable the government sometimes to make policies guiding businesses, and also for tax assessment, to know what they are expecting as tax from business organizations, and they can as well plan with such information. We have the customers. Customers are those that use the product of a particular business. They want to be sure. That is what they will be looking for in a financial statement. They want to be sure that this product that I'm buying today, or I want to buy, that the product will continue to be in place even in the future. Not that if I use this product today, tomorrow I go to market, I will not see it. So they want to assure themselves of steady supply. The analysts, these are the analysts. I would say that they are professionals. Their work most of the time is to advise their clients on a particular business to make investments into. For instance, if you go to an analyst as a client to the analyst will tell you, this business from analysis he or she has carried out, this business will continue to do well in the near future, but for this one, don't invest into it. So that is what the analysts do, and they are interested in knowing what goes on in any business organization. Then the general public. Sometimes a business is located where people will make demands on them to build schools for them, build recreational centers, hospitals, and things like that, even roads, to provide amenities for them. So the general public will also be interested in knowing whether the business has the capability of doing so. So these are some, not all, of the users of accounting information. Then, from here, we will go to accounting concepts and conventions. Accounting concepts and conventions. Accounting concepts and conventions. We'll pick them one after the other, beginning with concepts, then the conventions. Accounting concepts are the basic assumptions, or I will call it fundamental principles, on which the preparation and presentation of financial statements lies. So whatever we are doing in accounting, from beginning to the end, it must be guided with these concepts. Accounting concepts. I said they are the fundamental principles, the basic assumptions guiding the preparation and the presentation of accounting information, accounting statements. Okay. We have some of them on the board. We have cost or historical cost concepts, money measurement concepts, matching concepts, periodicity concepts, objectivity concepts, accrual concepts, dual concepts, realization concepts. So we take them one after the other. Beginning with business entity concepts. This is a concept which states that every business organization is seen as a separate being, a separate entity that is distinct from its owners. What he's saying is that a business can never be seen as being the same as the owner. In other words, the accounts of the business must be kept separately. The accounts of the owner or owners must be kept separately. And the business should be able to make its own decisions apart from the decisions the owners can as well make for themselves. That is a business entity. Although it is seen as a being, as if it is a person, but it is not a human being, not a living being, but an artificial being. Then the other concept is going concern concepts. This concept sees a business as something that will continue to operate in the next foreseeable future. It sees a business as something that will not end or stop tomorrow, that it will continue. And that is why there are activities like taking loan, selling on credit in any business organization. If a business organization is seen as something that will fold tomorrow, nobody will be willing to give loan to that business. And the business might not even be able to pay if such is given to it. The next concept is cost concept, sometimes called historical cost concept. This concept states that the value of the items of a business are based on the amount paid to acquire that particular item. So when recording any item in the business, like the assets, you record those items based on the amount paid to buy them. You do not consider the amount or the value that particular item has at the present time. You just carry on the cost at which that particular item was bought. Money measurement concept is a concept that states that the items recognized in any business organization are those items that can be measured in terms of money, in monetary terms. So any item that you cannot measure in monetary terms will not be stated in the financial statement. Then the next concept, which is matching concepts. Matching concepts. It states that whenever there is revenue, that revenue must be linked with the costs that led to receiving that revenue. Whenever there is revenue, you link the revenue with the cost that led to the generation of such revenue. That is matching concept. They must be matched. The revenue and its related costs. Periodicity concept is a concept that says that accounting statements, financial statements, must be prepared periodically in terms of time. There must be time attached to the preparation of financial statements. And it is acceptable that every financial statement should be prepared for 12 calendar months, which is 1 year. So, every financial statement should be prepared covering 12 calendar months, which is 1 financial year. The exception is on the commencement and the cessation of a business. Exception to the periodicity concept is on the commencement of a business and then the cessation of a business. So when preparing accounts for a business that is just starting, for that 1 year, it might not be up to 12 months because a business can be started at any time in the year. You can start a business in July, and by December, it might not be up to 12 months. You can start a business in April. By December, it will not be up to 12 months. Then on the cessation, a business can fold at any time. It mustn't be at the end of the year. It mustn't be by December. A business can fold any time in the year. So whatever statement will be prepared might not cover 12 calendar months. In Nigeria, 12 calendar months is January to December. In Nigeria, 12 calendar months. Financial year is January to December. Whereas in other countries, it might not be the same. Other countries, you might start from February and then end it in the next 12 months of the other year. But for Nigeria, January to December. That is periodicity concept. Then objectivity concept. This concept states that while preparing or recording accounting information, bias should not be introduced. Simply saying that you should not consider maybe faces, looking at people, because of this person, let me do it this way. No. You just take the real thing. The real figure is what you enter. You don't consider anything or anybody in entering or recording financial data. You take exact amount and record it. And that is why accounting also helps in fighting fraud and corruption, if it is done properly. Because you will not consider who will be affected. You will not consider whether you are the one that will be affected or your friend or your brother or your sister. You take the real figure. That is objectivity. Accrual concepts. is a concept that states that in a particular period, all the items of revenue and the expenditure should be recognized when they relate. This is just saying that it does not matter when actual payment was made or actual revenue was collected. What matters under accrual concept is when that particular transaction took place. Which period does it relate? That is accrual concept. Which period does it relate? For instance, I will take 1999 as an example. If salary is due for 1999, but that salary was actually paid in year 2000, accrual concept is saying that that salary that was paid in year 2000 but was due in 1999 should be recognized in 1999. That is the year for the transaction, not when the actual money was paid or received. That is accrual concept. Then dual concept is a concept that says that every business transaction must be recorded 2 times in 2 different accounts. One account must be debited and another account must be credited. And that is even where we get our double entry principle, which says that for every debit entry, there must be a corresponding credit entry. That is dual concepts. Then the last here is realization. Realization concepts. This concept states that an item of revenue, an item of expenditure is recognized as at the time, for instance, that goods are dispatched and a customer has taken liability to it. Once the customer accepts the goods sent to him, it must be recorded. You are not going to wait until that customer begins to pay. As far as the goods sent has gotten to the customer and the customer accepts, oh, yes, I am owing now, it is realized. It must be recognized. Realization concept. It is somehow related to matching concepts. So from here, we go to conventions. Conventions and their concepts, they are what guides the preparation and the presentation of financial statements. The conventions, I have just 3 on the board. They are just a general agreement reached on how to apply the concept, the basic concepts. While applying the basic concepts, some of them can conflict. You might want to apply this one, another one is showing face. Now, convention comes up to tell you what to do whenever you are in that situation and you do not know what to do. You apply the conventions. Consistency convention. This is a convention that states that while applying the basic concepts in accounting, once a concept is applied, it should be followed up till there is any reason to make a change. If there is any reason to make a change, the reason has to be stated, and the effect of that reason also should be stated. I will use an example of depreciation methods in accounting that we have. We have many methods of depreciation. We have straight line method, reducing balance method, some of the year digit methods, and many of them. Now, any business organization can select any one. What consistency principle or convention is saying is that immediately you select one, you should not quickly change to another one. You should continue with that particular method you have selected. You should not change. But if there is any reason for you to change to another one, you state the reason for the change, and then the effects of the change has to also be stated. Then Materiality Convention. Materiality Convention is saying that the items that should be recognized in a financial statement, they are those items that has good value. Those items of value. You don't just record anything just because you must enter everything. That is why if we have some small items, like a business organization bought pencil 10 naira, 10 naira should not appear as an accounting heading in a financial statement. Rather, this 10 naira for pencil with other small items should be grouped together, maybe called general expenses, sundry expenses, and things like that. So you recognize only items of value, items that are material in value. Those are the things you recognize under Materiality Convention. Then the last here is prudence or conservatism. Prudence is saying that an accountant should not be extravagant. Let me put it that way. But it's only telling us that an accountant does not anticipate income. An accountant does not anticipate income. You should not, because you are hoping that money is coming, money will come, you begin to record as if the money has come. But any foreseeable loss should be recognized. He's saying that accountants should not anticipate income, but should make provision for every foreseeable losses. So if I'll use an example, some people are owing a particular business. You now look at the situation, you conclude that this person owing will not and cannot be able to pay. What you do is that you make provision for bad debt. You write it off as expenses. But if you have hope that money is going to come from this person, you are not going to enter it based on the hope. You enter as income only those tangible, those you can hold actually, not what your mind is telling you. That is prudence and conservatism. So with this, we will go on to other topics.